Australia's rising jobless rate, what it means for the economy. Australia's unemployment rate has surged to its highest level in 3.5 years, raising eyebrows and prompting discussions about potential interest rate cuts in the near future. This development is particularly significant as it marks a shift in a labour market that had previously shown remarkable resilience. In June, the jobless rate climbed to 4.3%, a notable increase from 4.1%, reaching levels not seen since November 2021. This uptick is particularly striking after a period of stability in employment figures. The Reserve Bank of Australia, RBA, had anticipated that the unemployment rate would peak at 4.3% by the end of the year, making this data point a critical indicator of economic health. Despite the jobless rate rising, the overall employment figures showed only a slight increase, with net employment rising by a mere 2,000 jobs in June. This follows a downward revision of May's figures, which indicated a loss of 1,100 jobs. Analysts had expected a more robust increase of around 20,000 jobs, highlighting the volatility and unpredictability of the current job market. The Australian dollar reacted negatively to this news, dropping 0.7% to $0.6480, marking its lowest value in over 3 weeks. Additionally, yields on 3-year government bonds fell by 10 basis points to 3.386%, as investors adjusted their expectations for an interest rate cut in August, raising the likelihood from 76% to 85%. Harry Murphy-Cruz, the head of economic research at Oxford Economics Australia, commented on the situation, stating, "While we are still not ringing the alarm bells, June's slackening is another good reason for the RBA to get a wriggle on with rate cuts." He emphasized that the labour market is facing several challenges, particularly due to external factors such as tariffs imposed by President Trump, which are affecting business investments and leading companies to reconsider their hiring strategies. Interestingly, the labour market had remained unexpectedly strong even as the broader economy showed minimal growth. This resilience was a key factor in the RBA's recent decision to maintain interest rates at 3.85%, despite having cut rates twice earlier this year. The central bank is still cautious about inflation, awaiting confirmation from upcoming consumer price data set to be released at the end of July. So far, the impact of interest rate reductions on consumer spending has been limited, and economic growth remains sluggish. The details from the latest employment report were less than encouraging. Full-time employment saw a significant drop of 38,200 jobs in June, and the total hours worked decreased by 0.9% following a sharp increase in May. However, the participation rate did rise slightly to 67.1%, indicating that more people are actively seeking work. This situation contrasts with leading indicators such as job vacancies, which have shown signs of stabilization after declining from their peaks in 2022, with a 2.9% increase reported in the May quarter. Additionally, private sector data for June indicated a rebound in job advertisements, reaching 1-year highs. Tony Sycamore, an analyst at IG, pointed out, "There are clear signs of deceleration emerging in the labour market." This calls into question the RBA's decision to prioritize inflation over growth and jobs at its meeting earlier this month. He suggested that the RBA will likely reassess its stance at the upcoming August meeting. As we navigate these economic shifts, it raises important questions. How will the RBA respond to these changing dynamics? Will the labour market continue to weaken, or can we expect a turnaround? We invite you to share your thoughts and opinions in the comments below. What do you think about the RBA's approach to managing inflation versus employment? Let's discuss.